So as I mentioned earlier, right off top of the show, Bank of Canada had an interest rate decision, I guess, a meeting. Bank of Canada met, and they decided to cut 25 basis points off the Bank of Canada rate. So now coming in at 4.25%. It is the third interest rate cut by the central bank here in Canada, Bank of Canada, third rate cut in a row. Something that I was not expecting when we first started to see the interest rate cuts happening. We raised rates, or Bank of Canada raised rates many times in a row, as many as I think 8 or maybe even 10 times over a period of about a year and a half. And here we are now cutting rates 3 times in a row. First chart we have here actually shows this. You could see the interest rates now to the far right-hand side coming down. 4.25% is the new bank rate. Inflation rate in our country is 2.5%, as we've said recently. Inflation definitely coming down. And I guess the bottom line, which is a very important line, is GDP. And you could see how GDP is basically flatlining. And Bank of Canada continues to talk about how they are cautious. They're concerned about growth in our country. They're concerned about growth in the economy. They're concerned about jobs growth. We haven't really seen much in the way of jobs growth in the last 2 readings that came out. So they've taken upon themselves, the Bank of Canada that is, to start cutting interest rates, and even faster than most economists had predicted originally. Our next chart shows this as well. When we surveyed economists here in Canada, previous survey is the red line. You can see it here, that they were all predicting rates to fall, but the new survey predicts even a steeper interest rate decline, slightly steeper. So, I guess for me, I look at things, should the Bank of Canada raise rates? Should they have raised rates as quickly as they did, as much as they did, only to now see rates fall quickly once again in the other direction? Is the credibility of the Bank of Canada going to be called into question at some point? Perhaps they raised too much. Perhaps they didn't allow for this lag effect, as we talk about, right? You raise interest rates today, you may not see the effects of that interest rate increase for perhaps 6 months, 10 months, maybe even 12 months. So maybe the Bank of Canada didn't wait long enough before all these different rate hikes happened. And now we're seeing that, yes, it's now affecting the economy. It's affecting jobs growth. We haven't really seen jobs growth in Canada for the last couple of readings. And so the Bank of Canada is concerned. We're also seeing what we would call GDP going higher, but yet we're calling it because of certain reasons. We're saying that GDP is going higher because of immigration, because people are coming into this country, 2 million new immigrants to our country in a short period of time, and they're obviously all spending money, which helps GDP. We're also seeing the last reading of GDP. We have a chart on GDP per capita. There it is. The last reading of GDP was well above expectation here in Canada, but a lot had to do with government spending, not the private sector spending. So it's not the small businesses, the mom and pop shops, the private sector that is spending money to grow their business, to be more productive. It is government spending money, and it is spending of a lot of individuals that have come to our country in the last few years, which have taken up GDP. But if you look at this chart, you could clearly see that GDP on a per capita basis, on a per person basis, how much we have fallen behind the United States. The United States has gone up significantly, and yet we still seem to stumble. We're not seeing really much growth on a per person basis, and the Bank of Canada is definitely concerned about that. And so you factor this GDP per capita with a slowdown in jobs and an overall slowdown in GDP in general, and that's when you get Bank of Canada starting to cut rates, hoping to stimulate the economy a little bit, keeping the economy from falling into a recession, a hard landing. Obviously, the Bank of Canada is looking at a soft landing. To them right now, I guess looking more at jobs growth and the economy is probably taking a little more center stage than even inflation is at this point in time, because inflation in our country is around 2.5%, on its way to 2%. according to the Bank of Canada, whereas jobs growth in general is definitely slowing down. So can we expect more rate cuts this year? Well, most of the major banks in Canada predict at least one more rate cut in the next two meetings before the end of the year. So bringing down Bank of Canada rate to 4%, that should probably take prime rate to just over 6%. And then next year, there are predictions that we could see as many as 4 rate cuts, which should bring prime rate somewhere just above 5% and a bank rate to neutral, which the Bank of Canada wants to see, a neutral rate somewhere around 3%. So is a prime rate at 5% neutral? Well, we'll have to see how that affects the housing market and many other things. But I think the expectation for at least one more rate cut should be out there for investors. And if the Bank of Canada does that, they'll be right on track as per the major banks in our country, Royal Bank, etc. They're all predicting a 4% Bank of Canada rate by the end of the year. So one more cut perhaps in the books. We're now going to have to turn to what the Federal Reserve will do in the coming months.